Major moves. We going all in, like we got nothing to lose. We making moves. We making major moves. We making moves. We making major moves. We making moves.
Welcome back to my channel. I want to thank you guys for actively deciding to spend time with me. I'm just a guy in a Spider-Man mask, a cool one I might add. I'm not a financial advisor. I'm just providing information and content already on the internet, and I just read it and present it to you guys in a way that may reach you or may not reach you. Whatever the reason is you found my page, I'm grateful you're here, and thank you for spending time with me. Let's get into this. What is up, everybody? I am Mr. Man, and I got some sweet news for you guys today. It was all over Twitter. I was posting about it today as well. But I'm going to show you some connections here. We got SBI in the news. Yoshitaka Kawa, I believe his name is, with SBI and Ripple. And specifically stating XRP now. So all the haters can poof, disappear. Well, what banks are using it? The price is still 50 cents. What banks are using it? Yeah, and the world banks, the ECB, Bank of Canada, Federal Reserve, they're all still printing trillions and trillions of dollars. Alright, so this here, labor integration, migration in Asia, increasing the development impact of migration through finance and technology. Here we have the real regulators there, the OECD. That's one of the real securities regulators, okay? Not the SEC. These guys, they regulate us. These guys regulate the regulators. Labor market, increasing the development impact of migration through finance and technology. I'm going to skip right down to here. Here we go. Interbank distributes DLT applications more widely, could bypass correspondent banking. So remember all these things we're talking about here, okay? It's going to tie into the end of where I want to go. And promote direct settlement between financial institutions. One sophisticated operationalization of the approach is actually the product of a private company, Ripple. In fact, Ripple recently announced over 100 financial, this is back in 2016, okay? 100 financial institutions are now active on its enterprise blockchain network, RippleNet, wherein network banks can initiate and settle wholesale payments through crypto tokens. Ripple's not alone in this endeavor. IBM, MasterCard, JP Morgan, Swift, and the Gates Foundation are three, and more, all competing to establish the next distributed ledger. So, from back in 2016, we had news here of Ripple, all up in Asia. All up in Asia. Ah, it's FUD. This ain't real. It's nothing. Alright, so I'm going to show you SBI Remit. Let me just mute my audio so you can hear this audio perfectly.
Will be the best choice for your overseas remittance. Have you ever heard about overseas remittance? The remittance fee is so high, the process takes a long time. Here we go. SBI Remit is the solution. With low-cost remittance fees from $460 JPY. Send the money to more than 200 countries worldwide. Only takes a few minutes to receive the money. Bank account is unnecessary with our cash pickup service. A cheaper way to send money abroad, easy to register. That's why SBI Remit is chosen. What are you waiting for? Be our membership right now.
Grammarly Go is the only
Look at that. You can be our membership right now. They sum it up right there. Like, they don't even need me to do this now. But I will, because I'm good like that. So, here we have an article today. SBI expands XRP remittance to Vietnam, Indonesia, the Philippines. So we got connections now from 2016 to today. I showed you the video there, right in there, where you don't even need a bank. I showed you the 2016 document that states you don't need an intermediary, you don't need a bank. In that video, the SBI video, they state you don't need a bank. Right? Japanese financial conglomerate SBI Group has inked a partnership between its international remittance services arm, SBI Remit, and Ripple, alongside SBI Ripple Asia, to provide an XRP-based remittance service to bank accounts in multiple Southeast Asian countries. What more do you need at that point? You know, like, well, they're not using XRP, the price is 50 cents. Well, you can shut the hell up and back away. Give it some time. There's no liquidity in the system yet. Give it some time. Follow the sentiment in the market. Back in 2022, we were on a high going up. 2023, boom, we came down. We hit a rock bottom. I can't say rock bottom, but we hit a bottom of some sort, and we're kind of just trudging along the bottom here. I believe in September, this month here, today is the 6th, we're going to experience it even further down, because we got some issues with real estate, we got some issues with banks. We also have on the 20th the Electronic Trade Document Act coming into play. So for that coming into play, I guarantee you will see something manifest in our physical realm, our physical world, that we will see something that will fear the market to make a big sell-off happen. You don't have to believe me. I just tell you what I see, and you can take it as you want, right? That's how I roll here. So, along with that happening now, we had news of that SBI Ripple XRP being utilized in Asia. There's also big reforms taking place that not many people are following, but I am. Has to do with BASEL 3. Check this out.
Basel III came out in 2011, and since then the Basel Committee has made it clear that they've been working on a number of agendas around the Pillar 1 risks. So that's credit risk, market risk and operational risk. And the main implication is that it's expected that it's going to raise the capital requirements by about 15 to 20% for both credit risk and market risk. So in terms of numbers in Europe, that's in the hundreds of billions of dollars. So these changes are significant changes that are changing the way banks will calculate Pillar 1 risk capital. So the amount of capital they need to hold against credit risk, market risk and operational risk. They're being implemented. The final date for implementation is 2022. So it still seems like a long way off, but actually the impact is quite significant, and banks should be planning for this up front.
So, that's been implemented already.
intend to zoom.
Stop. That's been implemented already. Right? The Basel III reforms at that point, where banks have now a capital requirement. They have to hold a balance sheet now. Hold assets, hold something on their balance sheet, not just 0%, where I walk in, Mr. Man, here's my money, they turn around, it's gone. Like I was never even there. Hey, wait, I didn't mean to give you guys all that money. I wanted to take some back. What does the bank teller tell me? Sorry, buddy. We can't. Give us 3 to 5 business days for us to get your money back. Kind of like that South Park episode where, who is it? Kyle goes in to invest his money with his father. The banker takes the money and he's like, and it's gone. And Kyle's like, what do you mean it's gone? The banker looks at him, it's gone. What do you mean it's gone? It's gone. Just like that, it's gone. No capital requirements, but that's all changed. And what do we have coming soon? The Basel IV requirements, which not a lot of people are aware of. Let me get this queued up here, and we'll get this going. So you saw SBI Holdings, you saw Ripple, you saw Ripple Net there, you saw how they're going to be using that now for money to be going back and forth in the JPY currency, sent globally. You saw Basel III now, so banks are required to hold reserves. Let's check out Basel IV.
Good morning, everybody. My name is Erwin Lematok. I'm a partner at PwC in South Africa in the Banking and Capital Markets Group. I'm joined here today by Martin Neeson. Martin Neeson is a partner from our Frankfurt office. He is PwC's global leader on Basel IV. He's been visiting us for a couple of days to talk to us about Basel IV. Martin, how's been your experience so far?
I am now here for more than 3 days. I must say I love this country, I love the people. It's very nice here. Thank you for the invitation.
Thank you very much. And Martin, so you came to talk to us about Basel IV. Tell us a bit more about Basel IV.
Yeah, actually, what is Basel IV? Basel IV is a new framework for banks for holding capital against their banking risks. And there will be a complete overhaul of all the rules for the calculation of risk-weighted assets. Risk-weighted assets must be calculated for the typical banking risks, which are credit risk, market risk, and operational risk. Currently, the banks have to follow the so-called Basel III framework, and now they have to move to Basel IV.
Thank you, Martin. That's very useful. So what should the banks actually do now?
First of all, I think what is very important is that banks have to make clear what the impact of Basel IV actually is. Basel IV is a little bit different than the changes that we have seen in the past in banking regulation. In the past, we have seen rules where the banks were impacted pretty similar, like everybody was treated the same. Now, Basel IV is very individual. It heavily depends on the individual portfolio structure, on the business model of the banks. So therefore, the impact of Basel IV can be very different. And of course, the starting point is that every client, every bank is analyzing what this impact actually is.
Thank you, Martin. So what does that mean for the man in the street? What does that mean for them?
Yeah, that's difficult to say because of this individual effect of Basel IV. I'll give you a quick example. There might be some credit portfolios or credit products where the capital requirements, like the risk-weighted assets that must be calculated with Basel IV, where they will be increased by the new rules. But there are also in portfolios, and that's a little bit strange because normally regulatory requirements become always more strict. But with Basel IV, it's also possible that the capital requirements go down. So there might be portfolios, which have an impact of Basel IV that the prices for the people on the street, for the credits, for example, will go down. For other products, it will go up. Or it depends also on the individual customer. That's possible as well. So it's a very individual effect. So we can't say that the impact of Basel IV for the banks is the same, either for the clients of the banks.
Okay, all right.
Very interesting, huh? Now it's all individual. So whatever that individual bank's credit rating is now, it has to adhere to that, which means it's not just a flat for everybody. Every individual now is rated on their own credit. And with regards to that, how I believe it's going to end, where is this?
That's good. So
this quickly. This is very, very interesting. Watch this. This is the last here. This is the last. This is the last one to finally be implemented, I believe. This is called the Basel III Endgame, and this is for the US. Alright? What is the Basel III Endgame and why are banks worked up about it? When they say banks, it's US banks. See the US dollar right there as well. This is the endgame for those banks. A lot of these banks are going to fall off. And this is why a lot of these big conglomerate banks are going to just carnivorize. They're going to take them all in. They're going to merge them, essentially. When these small banks fall, the big banks are going to just take these all in and claim all the assets, like the JP Morgans of the world, the Barclays of the world, the RBC, TD, CIBCs of the world. Just cannibalize it. U.S. banking regulators will on Thursday unveil a sweeping proposal for stricter bank capital requirements known as the Basel III Endgame, aimed at ensuring the stability of big banks. You hear that? Big banks. Just like I was saying, these small banks are going to get eaten alive. While the precise details aren't yet known, regulators have said the rules will apply to banks with 100 billion in assets or more. They are expected to overhaul the way the biggest banks manage their capital, with knock-on implications for their lending and trading activities. Okay, let's get back to where we was. Where were we? Here? Okay. So, that being said, that brings us over to ISDA. We're following the International Swaps and Derivative Association, ISDA. And this came out in 2021. This has to do with the Basel III reforms as well. I'm just going to read through quickly, and just to give you guys an understanding and an idea of the connections I'm making here, of what's taking place behind the scenes. That way you know and have an idea, a better of an idea, you can make more informed decisions. Committee in response to the consultative document on the prudential treatment of crypto asset exposure. So, the Global Financial Market Association, the GFMA, I believe they're up there. Yep, GFMA, see the names up there? Forum, the Futures, okay, all these names, yeah, the Chambers, okay, Digital Commerce, okay. So they are the associates. Appreciate the opportunity to respond to the Basel Committee on Banking Supervision, or BASEL, consultative document on the prudential treatment of crypto asset exposure. If you follow my page, you know we've gone through the prudential treatment of crypto assets in the early years. I think my face is on slanted. Okay, so focusing on designing a prudential framework for crypto assets. Furthermore, we support the Basel Committee's decision to engage in an iterative approach related to the prudential treatment of crypto assets. At the same time, we call attention to the need for prudential regulatory certainty in the near to medium, oh my screen's all messed up, in the near to medium term, particularly given the pace of evolution and client demand for crypto assets. So, these clients want crypto assets. They need to get this stuff out there. So they need to roll out this Basel framework, which is already happening. We saw the Basel III endgame for the US. You saw Basel IV. You heard them talking about Basel IV. And each individual bank has to hold capital requirements. Where am I? That's where I am. Is this it? Is this a different one? Yeah, so this is a different one. My bad. This is a different one now. This is in 2022. So the other one we just read was in 2021. This one's 2022. This is comments in response to the second consultation on the prudential treatment now. So now this is a response. They had sent out a response to the BCBS before, the Basel Committee on Banking. Basel Committee on Banking, whatever the heck the S stands for. They responded back to them, and now they're responding back to them again. So the global financial markets, yada, 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 yada. Where is it? Right here, second page I want to read. Okay. With these principles in mind, the association comprehensive review of the second consultation has identified some features and calibrations that individually and collectively would meaningfully reduce banks' ability to, and in some cases effectively, preclude banks from utilizing the benefits of DLT to perform certain traditional banking financial intermediation and other financial functions more efficiently. As a result, banks would be limited in their ability to respond to their customers' demand for access to crypto asset products and services. That outcome is not in the best interest of customers, investors, or the financial system more broadly. Indeed, the role of banks in the financial system and the scope of the financial sector within the purview of prudential regulators could be affected. Thus, our comments aim to improve the mutual understanding of current and emerging risks, the role of existing processes and frameworks for regulated entities to manage such risks and to identify balanced solutions to help in the design of the capital framework that supports enhancing financial stability while avoiding overly restrictive limits to innovation. Getting this right is critical to meet customer demands and harness the benefits of DLT and similar technologies. For example, the speed by and transparency with transactions can be recorded using DLT. What DLTs do we know of? Better question. What DLTs do we know of that is now partnered with ISDA? You know what? I think we got a second, don't you? Let us, if I can see this mouse here, I'll do a quick search for y'all, and we can see what cryptos are partnered with ISDA here. That's the ISDA, and is Ripple? Is Ripple partnered with them? Oh, what do you know? Ripple Labs Inc. Who'd have thought? ISDA, right at the top there. Ripple Labs. Ripple's mission is to build breakthrough crypto solutions and to be the best there ever was. Okay, let's go back. Moving on. This now is the final responsive consultation on the timeline for implementation of the Basel III, the final reform package. This came out a few days ago, September 4th. So we are all caught up, my folks. We are all caught up. I'm going to skip ahead to here. So implementation dates for market risk and CVA risk. Members welcome the revised timeline of minimum regulatory requirement for the revised standards on the market risk and CVA risk to start no earlier than the 1st of January 2025, as this would be aligned with other major jurisdictions like the UK and the EU, and closer to the implementation date consulted in the US. So they're invested in this as well, which is the 1st of July 2025. So you have the 1st of January 2025, now the 1st of July for the US implementation. So we got EU and we got, who is it? EU and the UK going live with the Basel III implementations in January 1st, 2025. We got the US going live July 1st, 2025. We strongly encourage alignment of implementation dates of Basel III reforms across jurisdiction to avoid additional complexity and unleveled playing field issues. Everything has to move in unison. Alright? Additionally, there's more. Members note that the implementation of the reporting only requirement for the revised standards on market risk and CVA risk will start no earlier than July 1st, 2024. In this regard, members would greatly appreciate if the HKMA would consider a longer phase-in. So they're asking the HKMA for a longer phase-in. Why is that? So we have this new emerging entity known as the BRICS. Leading, who are the two leaders of that? We got China and we got Russia. This new economy, this new entity is becoming the global power. They've set themselves up in such a way. Brazil, Russia, India, China, South Africa, Turkey, Argentina, Saudi Arabia, Mexico applied. There's they have the team. They have the continents and the countries with them now. NATO is like done. That's why they're here asking China. Right? China's not asking them. They are asking China. So, as we're talking about derivatives markets now, let's move over to here. This is Australia's derivatives, ASIC Derivative Transaction Rules Reporting. This is their Federal Register of Legislation, okay? They are known as the Australian Securities and Investment Commission. So the ASIC Derivative Transaction Rules Reporting 2024, when does this take effect? That's what I want to know. Because we found out July 1st, 2024 for the EU and the UK, or sorry, January 1st, 2024. Is it 2024? 2025. Shoot. I think it's 2020. I can't even remember. Anyways, 2024, 2025, and I went too far back. $2024. Okay. So, follow that up now with a year later. We have the implementation of this new, not ISDA, but securities derivatives market in Australia coming live and right to you on October 1st, 2024. So, with that being said, I want to show you guys this here. So along with that, Ripple and Flash Payments in Australia, Flash Payments recognizes the game-changing benefits of the Ripple Consensus Protocol for international money transfers and was the first digital currency exchange in Australia to be awarded a license to operate from ASICs. We just read about them. So you know when they're going live right as the ASICs goes live there for their derivatives market. October 2025. But we are learning the game plan. If we take down these calendar informations, put them in our phones, put them in our computers. That way when they go live, it'll pop up. We'll have the pop up and notifications. We can just follow this. The game strategy is in front of us. We just have to capitalize on it. Okay. So, this is what I want to show you guys too. ISDA quarterly. Under scrutiny. I can't see. Recent market shocks have led policymakers and market participants to consider how the risk of liquidity shortfalls could be remediated. My spidey senses are tingling. Woo-hoo! Do we have the answer to how liquidity floods the market? Have you guys heard about this anywhere else? Because I haven't. I know I've done the digging and I've done the dugging, and we got this. All right. So, for that, I want to go to 17. Why 17, you ask? Let me show you. Where is it? 17. Time to automate. Recent financial market shocks have highlighted the need for greater standardization and automation in collateral management processes. Whew. That's how the liquidity gets out there, huh? ISDA is developing automated workflows and data standards that will reduce risk in this area. Is that so? Huh. Okay, well let's go to 17. I might just edit this part out here, but who knows? You all might see something you like as I'm scrolling through too. There was one other thing I wanted to show you guys. Not that. My computer screen to my left is spazzing. And I'm also very hungry too. I need to eat something. I feel like I'm losing weight thinking of eating food. I don't have much weight to me. Banks are discouraged from taking on market risks, so that perhaps no surprise the markets can seem more volatile. Yeah. What did I say? COVID? Yeah, okay. Here we go. Time to automate. Okay. So the challenge of raising sufficient cash to meet rising margin requirements has been a common theme of the various financial market shocks that have occurred since 2020. While regulators are reviewing margining practices, these episodes of market turmoil have also shone a light on the need for greater efficiency and end-to-end automation in collateral management. Margining practices in the derivatives market have changed significantly over the past 15 years with the introduction of mandatory clearing and margining requirements. While many firms have taken steps to improve their own operational processes and bring greater efficiencies to collateral management, further progress is needed across the industry to achieve more complete automation and interoperability and to reduce the need for manual intervention. Policymakers are rightly working to address the implications of recent crises and develop appropriate policy responses, but the industry also needs to focus on transforming collateral management processes. So we know how they're going to get that money out there. AI and automation. They tell us they're digitizing documentation. Ooh. The ETDA, the Electronic Trade Documents Act. Across the different phases of collateral management will support greater markets of efficiency and resilience in the event of future shocks, says Scott O'Malia, Chief Executive of ISDA. So you know it's going to happen again. There's going to be two more shocks, I think. Two more or one more. One of them. Following the implementation of post-financial crisis derivatives market reforms to mitigate counterparty credit risk, many more firms now post margin than in the past. Central counterparties require margin to be posted against cleared trades, while firms around the world must also now post margin against non-cleared derivative trades. Okay. Increased clearing and margining of non-cleared derivatives have led to an overall rise in the volume of collateral in the system. Among 32 firms in scope of the first 3 phases of implementation of initial margin requirements for non-cleared derivatives are 304 billion. Non-cleared. Hasn't been cleared yet. Has not crossed the system yet. It's still in IOU forms. It's just waiting to be cleared. Money was sent. Deal was done. Money's not cleared at that point. Still not cleared. 304 billion of IM was collected by the end of 2021, according to ISDA's 2022 margin survey. This represents nearly 40% increase in the 217 billion of IM collected by a similar pool of 32 firms in the end of 2020. According to the previous year's survey, as a much larger number of smaller banks and buy-side entities have been brought into scope during the subsequent 3 phases, the total number of IM posted is now likely to be much greater. While the increased number of entities posting margin and the greater volume of collateral in the system mitigates counterparty risk, managing a higher volume of margin calls can be operationally challenging. Okay. Wow. Hope you guys learned something today. I certainly have. Whew, ripples in there like swimwear. I'm a grown-ass man with a Spider-Man mask. Ripples with SBI Japan, SBI Remit Japan. You see them using Ripple technology. You see them using XRP. We read about back in 2016 how they're capitalizing on it on a technology similar to Ripple's, what they offer or they're offering, and then you saw it coming into fruition, and now we're here talking about the derivatives market. We're talking about US's is the derivatives market, well, I guess global, and we're talking about Australia's derivatives market and the roadmap and what to expect in terms of timeline and the Basel III reforms, the US's Basel III endgame, and what's coming for 2024, the Basel IV reforms for individual banks or entities or credit unions. Love you guys. I'll catch you all on the next one. Peace.
Making major moves. We going all in. Like we got nothing to lose. We making moves. We making major moves. We making moves.